session is going to be on, just to verify, I hope you hear me clearly. Can anybody just signify if you can hear me clearly and you can see my screen so that I don't make the wrong assumptions? Okay, good. Thank you very much, Mr. Isaac. So today's session is on breaking down discounted cash flow valuation methodology. It's a very popular valuation methodology, and sometimes if you try to read it for the first time, the way people explain it, they make it look really complex. But the thing is very easy. In fact, without you thinking about it, without you trying to go all academic, you find out that you already do this. You do this in some ways. You might not do it exactly the way we explain it, but you already do it. Something that we do is just like one of those things where you already do something, it's something everybody knows, then somebody comes up with a very regulated framework for it. So just understand that it's something you already know. And I'm hoping that in this session, I will help us to fully understand how we calculate it. So the calculation is quite strict, even though everybody understands the methodology, applies it intrinsically. Today, I'm going to help you to understand it better now vis-a-vis how it's being calculated in financial models and for valuation specifically. So, and let me move on. I need to do a shout out. I saw, he's gone. I saw Mayor Lloyd. He was my, or he still is my C-sharp instructor. So I was really surprised when I saw him. Okay, so a word from our sponsor. So UrBizEdge for now is the sponsor. We have other sponsors coming up, and what we are doing right now is even if you want to be a sponsor, we'll be very happy to have you as a sponsor. The whole idea is to enrich the learning process. So some people have volunteered to, especially foreign content creators. Most of the sponsors we have now are people from outside the continent, which is quite interesting because you think it should be easier to get people within Nigeria, within Africa. But then again, it's going to be a mix in the air. Maybe they will be in the they will be motivated to become sponsors. But what's benefit for you? So the benefit for you is that every week, that's the plan. Every week you're going to be getting gifts. So we don't know how many people we get, but obviously to be people who are participating in the sessions that we get those gifts. And the gifts can be training coupons, can be physical gifts, can be mentorship. We didn't really put a very narrow scope to what those gifts can be. Let me turn on back my camera. I don't know what went up with it. So that's just this slide you're looking at. I'm going on to the next slide. Voila. So what is discounted cash flow, right? Discounted cash flow is simply when you take the money you are going to make from a business venture, from an, in this case, now let's talk about a company. The money the business is going to generate, so money that will come in year one. So we are taking now as like beginning of, it's almost like what you call year zero, but I don't want to call it year zero so people don't get confused. As the start of year one. So just imagine that this is January 1, your financial year, or like the first day of your financial year. So anytime you're doing valuation, you typically are starting from now. Right now, 1 year into the future, what's the money that is going to come? I discount it, I convert it to today's value. 2 years into the future, 3 years. And if it's a business that does not have a fixed end, then there's a way to estimate for what we call the terminal value. And if it's a business that has a fixed end, that can be a lot easier. If you are going into a bridge construction that you're going to have to concession, like be owner of it for the next 20 years before making it government property where you can't make money from it, then in that case, we will not do terminal value as such. We will simply just model out, except if government is going to buy it from you at the end of that year, then that money they are buying it from you at the end of the concession period becomes terminal value. But you get the whole idea. It's simply when I'm going into something, all the money that is going to come from that thing. So another point I want to bring out is DCF can be applied to anything you are doing purely for financial gain. I've seen people apply DCF to going to do an MBA in a very expensive university in US or UK. So how do they go about it? The money you're going to spend up front, then the money you're going to be spending for the 2 years you're going to be doing the MBA, then by the third year, the money that will come in from you getting a good job. So that's why most of those universities, they put estimate of what their students who have graduated earn after graduation, like 1 year after graduation. It helps so you can be able to do your plan. If you're going to take a loan, then it helps you to know whether you can be able to repay comfortably. But more importantly, I've seen people use this as a way to do an opportunity analysis. Is it better I just stay in my career right now and grow, even though I might not grow as fast as what an MBA will give me, but rather than having to break the bank, take a loan and go for an MBA, and struggle for the rest of the next 20 years, 15 years to repay the loan and to get back on my feet? Can I just simply use DCF for it? So that's one unusual way of using DCF. Another way I've seen, which most people don't think about it, is real estate too, right? If you're going into real estate, we are all used to, oh, this property, how much is a property right beside it selling for? What about you think about it? This property I'm buying it purely for gain purpose, right? So what's the money I'm going to make from it? If I'm going to buy a commercial rental property, how much am I going to be collecting as rent? So those who live outside of the country and are able to buy apartments and lease those apartments, it's not yet common in Nigeria, but if you are into leasing to commercial businesses, then yeah, businesses are used to collecting property that way. So I'm going to take us through all of this. So you begin to see how you already apply this in your normal dealings that involves money, and then how you can begin to be much more methodological about it, doing it the right way, because most of us use approximate. So I'm going to move on to the next slide. I just want you to understand. I'll try and share this slide with us so that it becomes easy for you to have some of these concepts in mind, because this here encapsulates how you're going to apply it in financial modeling. It might not be up until year 10. Might be up until year 5 that the years you have explicitly forecasted for, and then the terminal. So I'm going to share this with you because it correctly encapsulates, summarizes what you will do when you are doing DCF for a proper business. But nonetheless, I'm still also going to show us how you apply DCF to anything that you are in for profit. So the formula as for discounting is one of those formulas that anybody that has some exposure to accounting, to finance, you will know this formula. It's one of the bedrock of financial decision making, especially when it comes to raising money to do a project, estimating whether a project is profitable. So these are the things we use. Okay, so the formula you see up here, this DCF equals to cash flow in year 1 divided by 1 plus the discounting rate raised to power 1, like that. Cash flow in year 2 all over 1 plus discounting rate raised to power 2. 2 is the period. Okay, so we're going to again do them. I'm just opening our minds to the formulas we're going to use. Then the slide below it, there is a pattern to it. Regardless of what it is you are creating evaluation for, specifically DCF now, you need to understand the business. So if I'm doing this for a company, then I need to understand the business. I need to understand what the nature of those businesses in that industry, what the nature of that business is like, and also that industry the business operates in. I'm going to tell you why. If you're doing a DCF for let me give something that is okay. I'll give you a real life example, right? Over the week, I was working on a model for a real estate development company. Let me use that word because that's essentially what they're doing. But they are going to operate across multiple countries, like let's say continents even. Okay, Now, what will be the projection of the revenue and some of the values I'm going to use, the factors I will use, is going to be completely different for when I'm doing for a software as a service or a tech company. Why? I'll give you an example. For a tech company, growth can be really fast. But you know the funny thing about the growth can be really fast. It's also the company's lifespan can be a lot shorter than for a real estate company, right? If you look around you, even if you look at small business people, you'll find out that people in real estate naturally stay longer in business than those who are not in real estate. Why? The business is a bit, that industry is a bit immune to turbulence. It's not as turbulent as a tech business, right? So that understanding makes it that most of the cash flow that is going to come from a tech company, a lot of times are going to come near to today. What do I mean by near to today? They're going to come like in the near term. It might not be like immediate short term, but not more than the mid term. Whereas the cash flow from a real estate property will be almost even throughout the lifespan. So it's not going to be like, oh, the bulk of the money is going to come from one period over the next period. You are expected to be able to some extent, people will expect that the money will keep coming in a predictable pattern because that's the nature of that industry. But for a tech company where what it is that is the foundation of your business can get disrupted by new innovation, by some, EP other guys who have come up with a newer model, then you find out that you can't just use the same method you will have done for a real estate business. Then you gather the historical, what's the business been like? What's been because the truth is, as much as the past is never the guarantee of what will happen in future, it's still the best. It's still the closest to facts that you have. So no matter what everybody thinks about the future, what has happened in the past is still a much more certain, a much more dependable factor than what everybody is saying. Okay, because if we know that in the past we are not able to price customer aggressively, our margin could not be more than say maybe 30%. Then in the future, that becomes our guiding benchmark. You can't just say, hey, we have this innovative thing we're going to do, and then the margin will suddenly become 50. If your money is going to be involved, you won't want to do that kind of a big jump. So that historical is very, very important. Then it becomes the foundation for projecting into the future. So if it's a new business that you do not have your own historical, gather other people's historical. Hopefully, let me not say obvious, hopefully you're not the first who is going to do that business, right? So those who are already doing the business, what has been their historical like? You don't need to be gathering their absolute figures. Most importantly, you want to be gathering their ratios. So what's been the ratio of direct costs? So when they make ₦1 million, typically, is it that they are buying 500,000 naira worth of raw materials and production processes? Is it that they spend, out of that 1 million naira, they're going to spend 300,000 to cover operating expenses, So because it's the same thing. When you set up your own business, it's going to be very much like that. You're not going to you cannot be an hospital and you go and hire bricklayers or cheap priests. It's the kind of people who are working in other hospitals you will hire. So project future cash flow. Then number 4 is now for a business that is going to be, in quotes, existing forever, because that's the truth. Unlike human beings, where we all know that everybody should be dead, hopefully, or like most likely before 100 years. So you could say on average, everybody is dead 80 years, 85 years. And nobody is going to, even if people say, hey, I plan to live 100, you see someone who says, I'm even happy with 75, and then life itself happens. So that can be a very acceptable lifespan for human being. But for companies, nobody can defend that a company cannot go beyond 100 years or 40 years. So in your own valuation, in your own projection, you cannot forever be projecting. You can't right now as we are be projecting what the company will be making in year 22,200. You know, it's not going to be worth the effort. Even if you have the energy to do it, it's going to be laborious for even people who are going to use your model, right? So we always project for the next 5 to 10 years. For me, 5, 6 years is good because the further you go into the future, the more you are going to be wrong. That's true. And also the less reward you are getting for your effort. You're just going to be suffering yourself for nothing, if you ask me. And another bad part of it is, if you're going to have to use this to source for money from bank, from investors, it gives you more trouble because they keep asking you questions around, oh, this figure you put in year 8, this figures you put in year 10, this figures you put in year 11. So you spend more energy defending what is not even going to ever happen, because that's the truth. There's no way you can predict what will happen 10 years, 8 years, 9 years from now. So everybody, if you ask me, people are really okay with seeing the next couple of, say, maybe 5 to 8 years, and then from there you just take a conservative and say, okay, at least we should be able to maintain some margin of profitability, some margin of cash flow growth. So that's how terminal value always gets computed. You know, it's always an estimation of, okay, we have projected up onto this period. Let's just say everything keeps growing 3% afterwards. Let's say everything keeps growing 4% afterwards, depending on the environment you are in. If you're in Nigeria, you could use a higher single-digit growth, because we all know price increase in Nigeria is not the same as maybe in UK or in US. But if you're in UK or in US, nobody's going to accept if you're using something like 5% forever growth. You know, it's really, really aggressive because they are in a low inflation environment. Okay. So number 5, which is the final thing that is the main reason why we are together in this session, is the DCF itself. So how then do you discount all of this to today's value? All right, so that's the end of the story. If you ask me, let's go and start doing the practical side. So I'm going to come out of the slide. I'm going to open an empty Excel file. And I'm going to start from easy things to complex things so that you get how this thing works. Let me increase the zoom of my laptop. I hope I turn on recording. Windows D. Okay. Okay, great. So let's start with something really, really easy. Okay, let's start with what we are all used to. Okay, so I'm going to start with what we are used to. Maximize. Okay. All right, so let me look at those of us in here. Who are my most okay, so I'm going to say let's say Isaac. So Isaac, you are interested in a commercial real estate property or rental income. Okay. So let's start with what we all know, right? So Isaac is interested in buying an office complex. Now, this office complex, right, has an income potential, rental income of say 4 million naira a year. Okay? Now, out of this rental income, Isaac is going to have to spend, so let's call it your operating or maintenance spend. Maintenance or admin spend. So the good thing with most real estate property is that you spend the most of your money upfront. So it can be really low. It might just be 400,000 a year is spending on to cover property tax, cover some things about that property. Okay. So what does this mean? So it has a residual income, residual income, which I can call the free cash flow of this minus this. Okay, so now the question is, what valuation, what should Isaac be comfortable paying for the property? So what should he value the property at? So that's the question valuation always tries to answer. What is the value of something? Okay, so now this property that we are valuing, there are two common ways of doing this valuation. There's what we call company comparatives. Is it comparable or comparative? Let me just use my friend Google to quickly get that for us. Comps. I'm used to calling it comps. That most times I'm struggling. Okay, comparable company analysis. Comparable company analysis. The common word is comps, right? But the truth is, it's called valuation multiple. So this is one way. We can decide to say, I want to use method 1. So I can call these valuation methods, or 2 most common valuation methods. Number 2 is the one we are doing right now, discounted cash flow. So how are we going to apply? Let me start, like I said, I'll start from what we know to what we do not know. So Mr. Isaac, you're the one buying the property, so let us ask from you. If you want to buy a property and you want to know what's the fair amount, what are you comfortable paying for that property? How will you go about it? Just tell me naturally what you will do, Don't try to overthink it. Mr. Isaac. Okay, can somebody maybe help us? Okay, you said one. Can somebody check? Can you all check the chat box? Maybe I'm not seeing correctly. So you wrote 1.5 million, and you want to be collecting in naira, I guess, and you want to be collecting 4 million a year. Maybe you go with a gun, or you point a gun to the people's head. No, nobody is going to sell a commercial property for you at 1.5 when you can make a rent of, in 1 year you collect your money like more than twice back now. So I don't want to accept that answer. Let me save this where it's easy for me to pick up. Okay, can somebody, Mr. Isaac, that your answer is not, bros, it's not realistic. Can somebody give me what you think? Do you want to unmute? How will you go about it? So let's begin to apply what we normally do and see how it aligns with what already exists in all these grammars we are saying. Okay, yes, sir. Mr. Mejab.
Okay, yes. Good afternoon, Mr. Michael.
Yes, sir. Good afternoon.
Okay, yes. I think we can use 10 times the free cash flow, between 10 times the free cash flow of 3, that is about 36 million minimum, depending on the location, if you are talking of properties.
Okay, so you are going to use 10 times the residual income or free cash flow.
Yes.
Okay. Has anybody bought a property amongst us, and what did you use? How did you, or maybe you even try to help somebody buy a property, and just tell me what did you use in that transaction? So we've gotten one answer. I would like to hear more answers, and then let's begin to now align it with what I plan to show us. Anybody? Maybe in the chat box, or you want to unmute and say, going 1, going 2. Please, let's say something so that it won't just be only me talking. Okay. I can go on then if nobody is wanting to say any more thing. So
Sorry,
for
Mr.
me,
Michael,
yes, sir.
Sorry, I did not get the question you are asking.
Okay, so the question is, if you look at my screen, so one of us, Mr. Isaac, is interested in buying a commercial real estate, actually an office complex. He's buying it so that he was going to be renting it out. He's going to collect 4 million a year as rent. He's going to be paying some property tax, do some admin expenses, not so much, but 400K. So every year he's going to have like a residual income, something that is completely his own, that is not going to have to take from it to pay for anything else. That is 3.6 million. So the question is, what should he be comfortable paying for the property? So this is the question that we are trying to tackle. Okay, so I've written out 2 common valuation methods, but I want to hear from people, what do they do naturally when you are trying to buy a property that you're going to rent out? How do you decide what's the right amount to pay? So is it clear? Okay, so I'm going to go on.
Yes.
But okay, does anybody want to say? Does anybody want to say anything you want to suggest the way you would have gone about it? Looking at
Personally, I think it's quite subjective because it depends on the location of the property, where it is located. So, for instance, if I have a property on the island like VI and I have a property on the mainland like a Festac or somewhere, the prices will differ. So I think it depends on the property. Then you also look at the buildings or houses in those areas. So more like comparing. So personally, for me, if I am the owner of the land, I will look at other houses too, then have a mean price, an average price that I can be comfortable paying for the house, and the kind of residents, tenants I'm trying to look out for. Am I looking out for high class tenants or middle income tenants or low income tenants? I think these are all the factors I would consider before I can actually place a price on the house. So depending on the location, that's what I just feel. So for me, someone like in VI now, I expect that because it's not easy to recoup your money in the long term, in the short term. So if I'm making a rental income of 4 million, I expect that maybe in the next 5 to 6 years, I should be able to make my full money back. So it will be like maybe 4 million times 6 or times 7, thereabouts. That will be how much I'll be able to spend for the house.
Great.
I don't know if I'm making sense.
Yeah, so you can see I've even written exactly what you said. Is this number 1? So that's the same thing, and that's what most of us do. That because that's easiest to do. That does not involve doing too many mathematics. Simple. What's the other buildings similar to mine in the same location with the same kind of features, servicing the same kind of tenants I'm going to also be servicing? What are they selling for? So that's called comps. So the same way as you do it for real estate is the same way you also do it for companies. So when you are doing this for businesses, right? When you're applying this knowledge for businesses, so for real estate, if you are really into real estate, especially high value real estate, you start hearing things like, per square meter price. So they could say, oh, land in Ikoyi sells for, I don't know, 20,000 naira per square meter. What's the meaning of that per square meter? It makes it very easy if you have a land there to just say, oh, what's the going rate? What are similar properties in that place selling for? And then the size of your own land is maybe yours is 1,000 square meter. You just use that and then you say, oh, this is what is fair for me. This is what I want to pay, or this is what I want to sell it for. You can decide to play around it. You can decide to say you want to ask more, but you know in your mind what it is valid. So if the person you are speaking with to was diligent and he used similar methodology, he's going to tell you that no, this is what the prices are selling for of this kind of property, and that's what I'm going to pay. And most times that's what you two will collect, because if everybody is very diligent in what they are doing, everybody's going to come up with using the same going rates. Okay, So good. In businesses, right? What's the equivalent? It's called price per revenue. So this price per revenue, which for a land of a building, you will say the price of the property. Actually, we call it enterprise value. Enterprise value. When it's a company, it becomes enterprise value. So enterprise value per what now? Is it per the revenue the business makes? Enterprise value per, maybe net profits. Enterprise value per what else? Per, it could be earning before interest. So there are many different commonly used similar comparative valuation multiples, we call them, right? So if you want to buy shares, and most of the time you're looking at the price and you're looking at what's the company make, so we call it P, price to earning ratio. So this is the comps method 1. Simply you doing a research. Now method 2, which is what we are focusing on today, the DCF says I'm going to take the different years, okay? And I'm going to take the income, the residual income, which technically speaking, you are taking the free cash flow, right? And then I'm going to ask myself one important question. What is my required, some other times you can call it expected, the grammar can be whatever you feel comfortable with, but the answer is the same. What is my required rate of return? So that's where Mr. Mijab's answer comes in. So this is a very, very important question that everything that requires DCF must have the answer to this kind of question. So according to Mr. Mijab, he says he expects that if he's paying 100 million naira for the property should be giving him 10 million naira yearly income. That's the meaning of 10 times the residual income, right? So what does that mean? It means his rate that he's expecting is 10 divided by 100. That is 10%. So for him, he's okay with 10% rate of return. So if I know that I want 10% rate of return, then a building is one of those things that you could justify as being able to exist for life. Okay, so let me just, someone can argue that, you will have to break it down, rebuild, but let's just go from simple to complex. So let's say this money is going to be coming every year. How much? 3,600. I'll be 3,600,000. So based on this rate of return, what is now going to be the discounted cash flow? So what's the meaning of discounted cash flow? If I take my expected rate of return and I apply it, so if you remember the formula, draw. So if the formula is the cash flow, right, into 1 plus the rates. So this is that rate. So cash flow in whatever period T, divided by 1 plus the rates raised to power period T. So with this, we can get our cash flow. If you remember these slides, that was why I showed us, you see. DCF is the summation of all of the discounted cash flows. Let me use that word. All this money you are getting, bring it to today's value, equal to this divided by 1 plus this. I'm going to make this absolute because I don't need it to drag. Then raised to power how many period into the future. So in this case, 1 year into the future. This gets us the value for today, right? And if I drag this down, right, I will get what the value will be. Okay, so the DCF is the summation now. DCF now becomes the summation of all of this. And can you see what it's giving us? It's giving us that you should not be willing to pay more than 36 million. Now, this 36 million, let's go back to the answer Mr. Mijab gave, right? He says he doesn't want to pay more than 10 times. Look at it. Is that not, is this times 10 not equal to the same 36 million? So that's why I say that what you already do in your head, the things you already do are the very same thing we are doing, but we are just using some formulas that sometimes when you look at the formula, you begin to think about them as really complex or way out of what you normally do or what we do in real life. No, these formulas help us to be able to undo all kinds of situations. Yes, Mr. Mijab does not have too much complex scenario. As far as he is concerned, he wants 10 times the residual income. But the reality is that what if you are able to raise the rent at 5% every year? That's where Mr. Mijab's 10 times residual income becomes insufficient. It becomes very difficult to apply. Why? 10 times what? Is it the 4 million? But 4 million is not what you are collecting for a life. You're only collecting 4 million this first year. Next year you're collecting. So that's where ability to use this formula is important, because this one can capture all those nuances. No business makes the same amount of cash flow every year. So you find out that in real life, things are not going to be the same value every year. So we can use something as very simplified as X times, So now let's see how if this is factored in, how we would have gotten the result. Okay, so if I come in here and I say this has to be growing at 5% every year, so which means the next cash flow is going to be equal to the previous one times 1 plus the growth rate. I make this absolute so that it will not be moving and my formula will correctly be picking 5% all the time. So when you do this, you see that the rental income is growing 5% every year. Okay. Now, this is what allows us to capture what we call the terminal value. If you have done a model and you've estimated what you make year 1, estimated what you make in year 2, using all the old revenue and expense and all of that about in year 5, and then you now say, okay, from year 6 going forward, everything should just be growing at 5%. So how will you know? So how can you value something that is growing at? So that brings us to, how do you value? How do you value 1, constant free cash flow? Growing cash flow. Okay. The thing is, they both have a formula. For number 1, the formula is the cash flow divided by the discount rate. Okay. Now for number 2, it is equal to the cash flow divided by the discount rate minus the growth that it's growing every year. Okay. So let's see how all of that play into. Remember the answer we got when everything was fixed, right? When it was the same 3.6 million every year, we got 36 million. Let's see if we had used this formula if we will have gotten the same thing. This formula says that 3.6 million that you are earning every year, let us divide it by the 10% discount rate, your expected rate of return. And if I do this, yeah, see, I get exactly the 36 million. So I could have saved myself the stress of doing all this breakdown and the space and all of the calculations I'm doing, and just use this formula once and for all if I know that it is constant cash flow I am getting. So that's how you can value even fixed income. If somebody says, oh, you know what, give us money and every year we'll be paying you 10 million naira every year. So your bank says we have this fixed deposit stuff where, you know, we're going to be giving you 10 million naira every year. How then do you value it? How then do you decide what rate of return you should expect? Yeah, for banks, it's a bit easy with fixed deposit because they will give you the interest rate ahead. They will say, you know, the fixed deposit is 8%. So that means if you put in 100 million naira, you're going to be getting 8 million naira every year. Now, the one that is tricky is AXA Mansard, Leadway. The insurance companies will come and meet you and you say, oh, and we say, you know what? Forget what the bank is doing. We are going to give you that 8%. Then we're also going to give you life insurance, which, you know, if anything, when you die, hopefully you should die at a very old age. We're going to award a huge sum, a one-time huge sum of 50 million naira to your wards. It becomes a bit tricky. How then do you value that one? So there are so many things in life that you will find out that to be able to decide between two options, maybe they say we are not even going to pay you, we're going to pay you 7%, but don't worry, our 7% is not low because in 30 years time or at X years time or when you retire, we're going to pay you one lump sum. How then do you value all of that? How do you choose between opportunities that have like very funny cash flow pattern? That's where all of this come in. So anyway, let's move on to what about when the property is growing at 5%, right? Property is growing at 5%. What does that mean? It means that we're going to say that the 3.6 million, 3, right, divided by, now the 10% that you are discounting by, which is what you expect the rate of return you are looking for, minus the 5% that your income is going to be growing at. So that 3.6 million will be growing at 5%. And when we do that, it says it's 72 million. Let's go and check if that's what we got here. Can you see that it's really close? So if I drag this one more further down, we will have gotten exactly the same 72 million. Okay, so these are some of those formulas that you need to have in your corner when it comes to discounting, because anytime you have situations where it's constant cash flow, boom, that's it. Or growing cash flow, boom, that's the formula. This is the DCF we are talking about. Then there's a third one, which is what happens in companies. Irregular cash flow for the first couple of years, then estimated at growing at a fixed rate. So this is what happens when we are doing financial modeling. We are saying that, so this is what we are saying. We are saying, let me look for somebody amongst us here. So let's take Formulaio. So let's say Formulaio Limited. We have done a financial model for Formulaio Limited, right? In year 2022, let's say you're starting a business, going to kick off in year 2022, year 2023. So we have done, like, for the next 1 to let's say for the next 6 years, we have done your revenue, your expenses, your income statement, your balance sheet, blah, blah. we've done everything. We found your free cash flow. What's the cash the business is generating, right? So in year 2022, you're going to generate, your business is going to generate 80 million cash. Year after, it's going to generate maybe 110 million. In the year after, it's going to, maybe you have to do some expansion. So you're going to spend on building your factory. So you have to dip into the cash flow for that. So it's generated smaller cash flow that year. But then you start reaping the reward of all of those things the subsequent year. So you instantly everything jumps up again, you know, to a really, really high amount. Then it starts going up steady. So these are the very well broken down financial statements when we talk about doing financial modeling. I don't want to open a client work. Let me go and open what will not get me into trouble. This one. No. This. Let me use the familiar one. So we've done all the plan, you know, what you're going to do, blah, 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 expenses for the next 6 years, you know, revenue. We've done all this very intensive amount of work to get what your income statement will look like, to get what your balance sheet will look like, to get eventually what your cash flow and what your free cash flow is going to be. And that's now what we are going to plug and say that's the free cash flow. So let's go back here. That's just to help you understand that these figures you are looking at are the result of many, many work that you've gone to the market, you've done your feasibility study, you've done your plan, you've done a whole lot of things to ensure that those figures are as close to you, well, as reasonable as possible. That's the word to use. So then how do we do the DCF, right? So remember the formula. Let me again pull up the slide. So the DCF says the DCF, the discounted free cash flow, is going to be, number one, what is the cost? Remember that question I say you need to always know. What is the required or expected rate of return? So for companies, right, that required or expected rate of return is called WACC, weighted average cost of capital. So that's what it is called. And it's simply, let me just tell you what it is so that you don't think of too much mathematics. If mathematics can be very scary. So imagine that you are your capital structure, your funding, your business, your capital structure as a company. You have 60 million naira loan that you took, and you put in 40 million naira of your own equity, or as family and friends put in this. So you have a 60% debt, 40% equity. Now the debt, which is the cost now. The cost of your debt, I don't know, so maybe Formulaio is into an eligible industry. The business is doing the kind of thing government, CBN, Bank of Industry wants to promote. So you are eligible to a very low interest rate. So you are collecting a loan from BOI at 12%. Okay. So can be debt rates, equity, return rates, which is what we call ROE. So the investors, what are they demanding to? So for the debt, it's 12%, right? People can argue that, no, it should not be the debt you have on your book. It should be the debt you can, when you go to the bank and want to borrow, they will lend you. And all those are arguments. But what everybody does not deny is, if I look at your books and I look at your current capital structure, then I should use what is current for you to. If we use that, nobody can fight it. Where they fight it is if you're going to raise equity, then they say, you might not be able to raise equity at that amount. I mean, raise new debt at that amount. But again, let's leave those what everybody doesn't agree with. Let's leave them out of this discussion. So let's say this is your BOI debt. You got this debt from BOI, and that's the conditions attached. Now for equity. Now everybody that is investing, so that's why many of us, you buy into all these agri-tech. They'll be like, oh, we're going to give you 20%. You look at it, oh, 20%, but one thing most of you don't know, it's not really like you are borrowing them the money. I hope you know that you're not borrowing them. Why? When they are unable to pay, you are not able to really sue them. That's the truth. You can't, there's nothing much you can do. You can try and squeeze your money out the way, if you partner with somebody to do a business and you find out that they are not, the business is going down south, you're no longer interested, you want to pull out, you can force them to give you back some of your money, right? That's what you are all doing when you do all those crowdfunding, agri-tech, and all of that. You're actually an equity investor. You're not like borrowing them the money. So just drop that concept, drop it out of your mind that you're actually. It's a very bad way of you are not on the books as equity this thing. But for them, on their own book, they can capture you as they borrow the money from you. But it also is a very funny thing because they are not going to be paying you any. Let's not go too much into it. So the key thing I want to bring out is why it's enticing to you is because you're like, if I put my money in the bank, they give me 10%. Even if I buy shares, I look at the stock market. Stock market has been like doing up and down, up and down. I'm never really getting, a guaranteed 20%. These guys are going to give me guaranteed 20%, 30%. So I can come and meet you too and say, you know what, we're going to give you guaranteed 30%, 20%. Join us to starting this business, and you become an equity owner. You pull your money with us, okay? So the same thing too. What's the ROE, return on equity, you are promising them? It's always implied. It's a kind of implied value. It's really never stated, but everybody has it as a benchmark in their mind that if you call any figure lower than that, they are not interested anymore. Okay, so, but you have to there's a way of putting a formula to extract out the figure, but let's not suffer ourselves with that. Let's say it's 18%. So all the guys who are part, maybe you yourself, your family members, and everybody you've taken money from, they are okay with 18%, return on equity. So what does that mean? What does WACC then mean? So the WACC simply says, right, I take the cost of debt, right? I multiply it by the weight of debt. Weight of debt in this case is 60%. Debt accounts for 60% of your capital funding that's why it's called weighted average cost of capital, okay? Plus, now, the cost of equity, right, times the weight, what portion is equity? You'll be like, yeah, this is it. Then this is where some of all the other things in finance that most of us don't care about begin to come in, right? You can't just stop here. I can't stop here. Why? There's what we call tax sheet that applies to interest payment on debt. What that means is if you carry a debt if you fund your business, that's why they say the best capital structure will always be a mixture of debt and equity. So most of us who as human beings think debt is bad, that's just your own thinking. But the moment you start going into corporate finance, debt is good. Some debt is better than no debt because of this tax shield. So how do we account for it, right? So I'm just going to write the formula so that I'll move on straight away. So WACC, where should I write? WACC is equal to cost of debt. So let's say cost of debt times weight of debts. right? Now, times 1 minus your tax rate. So that's how we account for that tax shield. Okay. Then plus cost of equity times weight of equity. So you'll see that we have done pretty much everything except this one. So I need to go back to my formula and capture that part and say, I need to let it reflect that because you have some debt, you're going to get some advantage. In terms of your cost of capital, we reduce a bit because there is a tax shield. The amount of tax you pay reduces because you deduct interest payment on debt before paying tax. Maybe another day I'll go into it. I've gone into it before. Maybe I'll look for the video where I explain it. But for now, I don't want us to get sucked into that rabbit hole. So in Nigeria, we conservatively use 30% for tax rates. You could use 32% if you want to capture ETF. But I'm just going to leave it at 30%. So this is going to get us the weighted average cost of capital. I'm going to plug it here and say 12.24%. So now that I know this, we can start calculating and saying the cash flow, if you remember this formula, right? The cash flow in that period divided by 1 plus R raised to power. So divided by 1 plus, this is that cost of capital. I make it absolute, raised to power. What period now? This is year 1, which is period 1 in this case, right? So I've done everything in such a way that I can drag. So I'm just going to drag this up onto here. So now what I've done here, I've done what we call the explicit forecast period. Okay, now the business is going to continue after now. So for this one, we need to do terminal value. So this becomes a case of where we have done for the regular cash flow part. We've done for the we've done for this irregular cash flow part. So we are now left to estimating the growing at a fixed rate. So we are back to now part 2. Like, how do we now estimate that, this thing will keep growing at, I don't know, 4%. So if we say this is going to keep growing at 4% every year, so we want to say at least the business should be able to keep growing long-term cash flow at 4%, maybe in tandem with inflation and general economic reality. Then we have to use this formula now, this number 2 formula that says, good, so that cash flow. So if it's going to keep growing at 4%, what does that mean? It means year 2028 is going to be equal to this value times 1 plus 4%. I'm going to make this absolute. And like that, I'll keep doing this like forever. Okay, so this is beginning to look very much like what I have done here, where we did a formula, remember, and we just keep dragging it down. And then when we calculated the value, I told us that we could have just done the same thing by doing this, right? So voila. So that's what we are going to do. The formula that will have gotten all of this for us is now that terminal value. So that terminal value is going to be, all of this money now is going to be equal to cash flow we've already done everything up to the year. So the next cash flows we are trying to gather from here, right? So this next cash flow, right? Times, no, it's not times, divided by, yeah. So that next cash flow, that's cash flow that is going to come, divided by, into bracket, the weighted average cost of capital minus that growth rate. This is going to now get for us the terminal value. So this is how we calculate that terminal value that you always see. Okay. So the only other thing I need to let you know is that most times you will not do what I've done. You will not, so that you don't even confuse the people reading your model. You will not be doing this. You will not do this part. So I'm going to delete it because we don't do this part. You see, the moment I deleted it now, this one is no longer showing. Why? I'm referencing this. Okay, so I need to, and if you remember what we have here, what's the formula we have here? Is actually this. So what will I do? I can just take this formula that we have here and redo it here manually and say, you know what? Instead of me doing it one by one, and this next year's value is going to be equal to this one times into bracket 1 plus this growth rate that we're talking about. Then all of that now is what is going to get divided by this. So again, I know it's beginning to start looking a bit like eye twisting, but you get all what I've done. So now I can safely delete this because you don't normally put this in your, it will confuse people. They will not know what you are trying to do. So this is now the terminal value. So eventually, let me say it again. I like the way it sounds. Eventually, can you see some similarity between what we've done and where we are now? So we've done a situation where we've gotten everything for here. And then we have now gotten this one too. So we need to add everything to get this, our company's value. So that's what we are going to do. So the enterprise value is going to be the summation of these two, the explicit period and the, so our DCF, the enterprise value, the company's what? Is going to be equal to the summation of all of the DCF of this period, right? Then plus, now this is our terminal value. It was taken as at year 6. So I need to still discount it back to this year. So I need to discount that year 6 because that's taken as if from year 6 what is left. So I need to now say that terminal value, discount it back to year 1. So because this raised to power the year 6, so to bring it back. 6. Okay, so I hope I did not now give us a headache. But that's it. It's just, I'm sure you get the concept. It's just a formula that might take a bit of adjusting. Maybe I'll give you my material where I also have those formulas. I have a book, but I'm not supposed to give you the book. You are not paying for the book. It's the book that I give people who pay for our training. But in that book, I wrote out the formulas. So it makes it easy for people to, maybe I'll go and grab a slide. Yeah, I think I have a slide. I have a slide for that one. Okay, maybe I do not have the slide. What I will do is I'll grab the portion from the book and put it in the slide so that I'll give you the slide. And once I give you the slide, you will have it. So this is that one, be calculated. Let me grab this because you might need this too. Grab this. I'll put it in the slide for you. So at least you will have that formula I did. Then where is that? This is that terminal value. So I'm going to grab this one too. Grab this one too. Which other one should I grab for you? Hey, this one is going to give your head spinning or your head will start. Hey, that. I'm going to grab this one. Even if your eyes will turn, just sit on a good chair so that when you recover, you look at it again. Let me grab this one. So I'm going to grab this and say, good. So I'm going to add this to the slide so that once I give you, you will have the computations too. I think I might need like 3 slides for that. So delete this. So any questions? I'm done, kind of. I'm just trying to include this in the slide. I will give us this. Let me save and close. But by now, you should understand from first principles. So we started with something very straightforward. You want to buy a real estate property. And the money that is going to come, then how will you value it? So we started from something everybody can relate with. Thank God you all gave me ideas, right, as to what you will do. And then we went from there to how the same thing applies to when you're doing for a company. You know, how do you have to do for the regular cash flow, and then you will do for the part where you are estimating that at least they should keep growing at a particular rate. So any questions? Let me save this, put it on where I can share it with you. So while that is happening in the background, please, if you have any contribution or questions, I'm very, very happy to hear your contributions or questions.
Hi, Michael. Good afternoon. Can you hear me?
Yes, very clearly. And it's a pleasure having you with us. This is the very renowned, super popular HR champion.
Oh my God, there's no how to me in this world.
We all know you. Pleasure.
Okay. Thank you so much. I mean, I'm someone who's really passionate about learning, and of course, I'm also trying to pivot into the business space. So moving out of just being an HR specialist or HR leader into understanding core business. And of course, that comes with having very deep understanding with financials to increase my financial acumen. So thank you so much for this. Unfortunately, I joined late. Yeah. So I wanted to find out, are we going to get the recording? How do we make progress, just in case we want to sort of make reference to a few things you had shared earlier? I'm personally interested in the real estate valuation that you mentioned, but unfortunately I missed that bit of your session. Thank you, and well done. Great job. You were very articulate. I made it all look so simple, even though
it is actually.
Even though the formulas look a bit complex, but you made it really simple and relatable. Thanks and well done.
Thank you too. So to answer your question, the recording we are recording it actually, but it will be out tomorrow, and I'll give you the link of where you will be able to grab it. So it's going to be here. Hopefully by this time tomorrow it should be there, because my team member who is in charge of editing and all does it on a Monday. So I'm going to just quickly give you the recording will be live by tomorrow. So please just check tomorrow. And yes, I've been failing with sending us, because I don't want people to get too much emails. Naturally, if you are part of this community here, so let me just give it to us. You'll be getting whatever materials the speakers share, the recordings. So now that someone has requested, I will also do this, because there are some people who even miss the session but plan to. How will they even be aware of the material? So all materials that speakers use, well, that are now I'm going to start, because I've been failing. I will have to ask my colleagues who help me with this organizing to maybe help me with that, so that I don't fail in that. But they will naturally be made available. All materials that speakers are made available. All members of putting the link. So in case you've not joined this meetup community, I will say please do, because the way it's supposed to be is that every session we have, what resources the speakers share, we send it to everybody there. All I just do is go here, contact attendees, and I send it to them. So it makes it a lot easier for them to get it in their email. So that's one thing that I will also advise anybody who has not joined that meetup page. So while there's a feedback I would like you to fill, if you check the chat box, right? So there's a leave us your feedback. It helps a lot with helping us know what topic you would like us to talk about, what suggestions you would like to give us to do. So I've shared it in the chat box, okay? So please give us, I want to upload this now so that you can have it and then you can go ahead with your Sunday, because I have already taken more than the 1 hour we usually set for this session. So save, upload. Is that my upload to? Good. Upload both the Excel and the slide. I have a very good announcement to make. I want to upload it, so I give everybody, so that those who at least have stayed up to here, you get it first. Then if you don't want to listen to my announcement, at least you've gotten the key things from today's session. So let me quickly upload. Pick the file, the practice file, upload, and the presentation file too. This one. Good. So the link, link. Good. So these are the links of the materials, today's files. This and this. Okay. So with that, if you need to rush somewhere, please go. Just make sure you grab this before you go, so that it won't be a case of you left the session and then you couldn't get the link again. And please also don't forget to share your feedback. Anybody has a question or contribution before I wrap up today's session? So while I'm waiting for any feedback or contribution, I want to let you know that something very interesting, we've been able to get some sponsors. So from next week, for this financial modeling, we've not yet gotten sponsors yet for financial modeling, so you might not win a gift yet. Announcements about gifts from our sponsors. You can read up on it. I'm sharing the link. So, but I can give you the full gist while you can read up later on the whole thing. Right. So starting from next week, there will be prizes that will be given every session. Again, for financial modeling, we don't yet have a sponsor that is donating gift yet. We have already for Excel, Community. We have for Power BI. And for the Power BI, it's a big one. The sponsor is giving us about 3,000 watts. So the winner is going to get a 3,000 USD watts of training coupon. Training is Enterprise DNA. So Enterprise DNA, it was amazing. When they said it, I had to remove my glass when I saw the mess and literally clean it and say, am I looking correctly? Am I seeing this correctly? So Enterprise DNA has become one of our premium sponsors, and they are making their entire, if you go there, they build in a year what you would have paid about 2,000 something for, you are going to get it. So we can only give one person a week anyway. But it's even if you are not the lucky kind of person, you just showing up every week, you will definitely end up winning, because how many people we will ensure not to give the same person. So it's just natural that a chance of everybody getting it, goes up. But the other thing is, the more people find out about this, the more competitive it becomes, where you have more crowd. So it's better, you plug in early so that you don't miss out, especially if you're interested in Power BI and all of what they train on. So all of the entire content, all of these, that let me look for where you will have paid if you're going to pay out of pocket yourself. Where's the price? This thing is giving me login. Anyway, that's one. And you can check it out. We'll announce it formally too. Then for the Excel, I don't know if you know the king of dashboard, Midna Tracy. Is the king of dashboard. She has also donated a dashboard course to a lucky winner. So I don't, if you have ever searched about dashboards, there's no way you will not have come across her. That, did I say king? Queen of dashboards. So she's also giving us, she's awarding to a lucky winner. I don't know if it will be, it's going to be monthly or what, but I know that for now, one lucky winner is going to win this, where she's going to give her course freely to that lucky winner. I even want to be the lucky winner because I've known her for many years now, and anytime that comes to creating dashboards in Excel, she's the one. She's the queen in that spot. And then Onyx Data. Onyx Data, they also too, the principal person there has given us that is going to mentor for free one person from our community. Just that this is the Power BI, because so it's not someone from financial modeling that will win it, but these people, they are based in UK, and they're into consulting, so it's a very big experience. Imagine you getting mentorship from a leading UK consulting firm. You just putting that on your, apart from the knowledge gain, putting that on your profile, makes people take you even more seriously too. So many more too. There are other people we are still waiting for them to get back to us on in what capacity they want to sponsor. But the key thing is that I'm letting you be aware, so that you that have been with us this long don't miss out, while people who are joining because of these give freebies and how they want grabbing everything. So thank you very, very much, and thank you, and have a very nice rest of Sunday. And I think no more questions. Yeah, Tochukwu, thank you to you. People are the motivation for us going ahead, because sometimes even till now, Sunday feels like my Monday. But when I see the thank you people say, I see some of the feedbacks, on like in places I didn't expect. I go on LinkedIn and I see someone just tag me and say, he's learning. So that's like my own motivation to continue our motivation. So thank you too for making it possible for us to bring this to you every week. And so let me let you have your Sunday back to yourself. Bye bye, and have a very nice week ahead. Bye. Ending the session.